Q1 earnings were good but not great. That's the word coming in from Kotak Institutional Equities. They say that stronger than expected results from the likes of ONGC contributed to the positive surprise, while many others disappointed significantly. To give us a snapshot of the entire earnings season, Sanjeev Prasad, Senior Executive Director and Co-Head of Kotak Institutional Equities, joins us now. Sanjeev, hi, good afternoon. Thank you for taking time out this afternoon. I was going through your note where you say that earnings were good but not great. But, going forward, just based on this quarter's earnings, which are the companies that impressed you, where earnings upgrades could be seen, and where there's still more potential for a stock upside?
Well, looking at the results, so far we haven't seen any meaningful upgrades. If you look at the BSE 30 index net profits, we were pretty much at that 13.5% growth for 2015. At the start of the result season, we are 13.5% after the result season. Same way, if you look at 2016 net profits, we're looking at about 15% as of now. So minor upgrades on 2016 basis. So as of now, we are not seeing any earnings upgrades, and that was pretty much expected. Remember, this is only pretty much the first quarter of the new government. Not even that. I mean, the government was formed in the middle of the quarter. And of course, you don't expect any miracle to happen in the first quarter itself. So things will take time to recover. Also keep in mind the fact that India's earnings, a lot of it comes from sectors which do not have a direct link to the Indian economy. In the sense, you have a lot of companies which derive their revenues and profits from overseas. The entire IT, pharma, as also Tata Motors, for example. Same way, you have a lot of companies whose earnings more depend on the global commodity cycles. Third, you have companies whose profits are regulated, such as NTPC Power Grid. And fourth, you have companies whose earnings are controlled by the government, so as to say, the public sector oil companies. And that's about 60% if you look at the BSE 30 index or the Nifty 50. So as of now, not seeing any upgrades. If you start seeing economic recovery gathering momentum after the next 2-3 quarters, maybe you will start seeing some upgrades coming in. Maybe the auto sector, banking sector, sectors which have more of a direct link to the economy, but nothing as yet.
Sanjeev, hi, good afternoon. And that's an interesting point because, in your report you say that the earnings growth were led by overseas sector, but exchange rate would be less relevant after first quarter. So, in a sense, are you saying that the kind of rally that we've seen in domestic cyclicals, that was justified and maybe earnings would now follow over the next 3 or 4 quarters?
Well, that is correct. We are clearly looking at the fact that you will start seeing economic recovery gathering momentum. Some of the economic reforms we put in place by the government start, contributing to higher GDP growth going forward. Remember, next 2-3 quarters, nothing is going to change. It's too early for that. But starting, let's say, fiscal 16, you could see GDP, getting to over 6% by fiscal 17 if everything goes well. I wouldn't be surprised to see GDP growth in the range of 7%. Fiscal deficit could be down somewhere in the range of 3 to 3.5%. If the government continues on fiscal reforms and investment reforms, which are being done at this point in time. Now, coming to the earnings bit, if you look at what has happened this quarter, a lot of earnings came from sectors which benefited from a weaker rupee on a YOY basis. If you recollect, the rupee depreciated significantly in the second quarter of last year. And if you look at the average rupee-dollar rate in the second, third, and fourth quarter last year, it was in the range of about 62 rupees to the dollar, whereas currently, let's say, it's about somewhere about 60, 61 as of now. So going forward, you will not get this one kicker which you saw in the first quarter. That is, companies whose earnings come from overseas, they benefited obviously because of rupee depreciation. That will not repeat in the second, third, and fourth quarters. So that's the reason why if you look at the first quarter numbers, even though we had 19.3% YOY growth for the BSE 30 net profits, as a whole for the year we are looking at only 13.5% growth for the BSE 30 index. So, I would assume that the next few quarters you will see somewhat more muted earnings growth compared to what we have seen in the first quarter of this year.
Okay. It's interesting, I was going through your revised model portfolio, Sanjeev, and you've removed BPCL from your portfolio. Given that crude prices have fallen and, diesel under-recoveries will get wiped out by the month of September, don't you think the quality of the earnings of many of these oil marketing companies will improve? Thereby, it would be prudent to have them in your portfolio?
Well, we already have a lot of oil and gas stocks in the portfolio. As you can see, we have GAIL, we have oil, we have Indian Oil, and we had BPCL also. It's just that BPCL had already performed quite well. Maybe I took it 2 days too early, I would say. But you are right in the sense that the earnings quality of these companies will improve going forward. Earnings numbers as a whole should benefit because of lower subsidies. I assume the government will act fairly and reduce the under recoveries for the downstream companies as also for the upstream companies. If you look at the broader numbers, last year the total under recovery was about 1.43 trillion rupees. 2016, assuming nothing happens on LPG and kerosene continues the same way, our computation suggests that under recoveries would be in the range of around 700 to 750 billion, taking oil at 105 to 107.5. So effectively you are seeing subsidies halving between 2014 and 2016, and clearly some of the benefits of that should flow to the oil and gas companies. So far unfortunately the government has still not articulated a more transparent subsidy sharing system, but given the fact that subsidies have come down quite significantly, I would assume in the next 1 or 2 quarters you would see maybe the subsidy discount for the upstream companies coming down significantly from the $56 per barrel number currently. And more important, I won't be too surprised if we see the likes of BP, HP, IOC and GAIL being completely removed from the subsidy system. I mean, there is no logic for them getting subsidies anyway to start with. And last week we recollect between BP, HP, IOC, GAIL, the amount was about 40 billion rupees. So why even bother about 40 billion rupees when the overall under recoveries will decline by somewhere about 700 billion rupees between 2014 and 2016. So I think the government might as well exempt the downstream companies fully. I mean, downstream I'm including GAIL also. And whatever little has to be charged, it can be charged from the likes of oil and ONGC.
That's an interesting point. Sanjeev, the other stock where we've seen quite a bit of earnings re-rating has been Tata Motors. Do you sense that it's approaching maybe over-ownership since you've analyzed some FI data as well? And how would you approach a stock like Tata Motors now?
Tata Motors, we have been pretty positive for some time. Even last time we were having the same conversation, stock was somewhere about 470 if I recollect. And we continue to be positive. Our fair value is 590. We are looking at pretty strong growth in overseas volumes both in 2016 and 17 when you start seeing more volume or more variants of Land Rover as also Jaguar being introduced. Also you will see the China JV starting to contribute in a small way from 2016 onwards. So we continue to be pretty positive in the stock despite some news flow about prices being cut in China and maybe margins coming down a little bit over there. But that's something which we already built in our models, that the margins which you have seen in the first quarter of 2015 will not sustain, and accordingly we have brought down margins by about 12 basis points over the next 2 years.
Okay. I just want to go over the other note that we have of yours, which is the KOTAK Ownership Navigator. And that's quite interesting, because I was reading that mutual funds have reduced their exposure to consumer products, but have increased their exposure to banks and industrial stocks. But I just wanted to understand what the rationale is that mutual funds have been increasing exposure to the banking space. Is it the impending turn of the NPA cycle?
Well, I would assume they are looking at the fact that banks will benefit significantly from any economic recovery, both in terms of loan growth, also pick up in non-interest income, that is fee income going forward. And hopefully, as the economic recovery gathers momentum, the government starts addressing some of the underlying challenges in sectors such as, let's say, power, which is a big contributor to the overall loans. Is about 9% of the total banking system, and there are a lot of concerns about potential NPAs from the power sector. But hopefully, you will start seeing some of those issues getting addressed over the next 1 to 2 years. So I assume that's a call people are taking, that banks are a good play on the economic recovery theme. And as we go forward, trade growth and bottom line growth will also pick up, and some of the NPA issues will also get sorted out.
Okay, so again, I'm reading from the same report, Sanjeev, and clearly, one stock that again stands out is United Spirits, where a lot of FIs participated in the open offer, and it's the only index stock which is in the red year to date. What's your sense? Do you get a sense that the stock has topped out, and with a lot of strong hands getting out, maybe we've hit a bit of a peak for United Spirits, or do you think it's just going through a bit of a consolidation and would rally again? What's your in-house call on that stock?
United Spirits will actually like the company. Our fair value is in fact 3,000 rupees, and the call we are taking is that over the next 1 to 2 years, you will start seeing some normalization in the earning numbers of this company. And remember, this company has fantastic brands, and given the fact that it has obviously been, you've seen a management change, you haven't seen the fourth quarter results of the company coming out as it, lots of issues about some of the bad loans and advances being written down, a lot of inventory correction, all the stuff is being done. So obviously there is a lot of bad news out there, but I think the more important thing is how will this company fare once some of these issues have been resolved. And if you look at the EBITDA per case of this company, that is somewhere about 80 to 90 rupees per case as of now, which is in fact lower than even the much smaller companies such as Radico or Tilak Nagar. I mean, if you look at their EBITDA per case, that's in the range of around 100 to 120 rupees, whereas even NSP is a much larger company. Actually, volumes are 6 to 8 times that of the other two. If you look at Pernod Ricard, they have the EBITDA per case somewhere about 350. Now, can this company normalize its earnings over a period of time, and the EBITDA per case, let's say, goes to somewhere about 170, 200 kind of a number? And if that is the case, then you're looking at a company whose earning numbers would be at 170, it should be about 100 rupees. At 200, it would be somewhere about 125. So if you take about 100 rupees, and the stock is available at 23 times, which is not too bad for a decent quality consumer company in a space which is very consolidated at this point in time, and which will grow quite significant in the future. So that's the call we are taking, that hopefully as we go forward, some of the issues which have plagued the company in the last 2-3 years will get sorted out.
Okay. Then one final question from my end, Sanjeev. In your list of highest increase in stake, it's interesting to see that mutual funds and insurance companies have increased their stake in Aban Offshore. I mean, that's a company that has that's up almost 90% this year already. But what's the trigger that could sort of take the stock higher, and why so much interest in this one?
You're asking the wrong person, Aban, honestly. We have covered the company, but it's not a rated company. There was some offer over there, so I assume people participated there. I assume the call which people are taking is over a period of time the debt issue will get resolved. But let's see how it goes forward, because when I look at the underlying financials of this company, if I remember correctly, the EBITDA is somewhere in the range of around 22 to 23 billion rupees, and debt is more in the range of around 130 billion rupees. So it's going to be a long time, before the debt numbers actually start to come down in any meaningful way. Also, maybe people are taking a call on the fact that global fleet utilization has started to pick up of late, and hopefully as and when some of the new rigs come up for rebidding, maybe they could be at a higher rate. So I assume that's the call some of the investors have taken when putting money in their stock.
All right. Sanjeev, one final question then. You say that the market is fairly valued right now at 17.4 times 2015 EPS and 15.1 times 2016 EPS. So would you say that we would consolidate at current levels and it would be all about bottom-up stock picking? Or do you think the market can enter a bit of an overvalued zone over the next 6 months or so because of the kind of liquidity that we have seen and the kind of global market, bull market that we have seen?
It's entirely possible if you see a lot of reforms coming from this government over the next 6 months, and I'm quite hopeful that you will see a lot of announcements in the next 6 months in terms of both fiscal reforms as also investment reforms, particularly on the fiscal side. I think GST will get announced in the next 6 months in terms of the structure of GST being in place. Hopefully the implementation will take place by maybe April 16, I would think. Similarly, on the investment side, a lot of things are being done behind the scenes to ease the bottlenecks when it comes to investment. Some of the benefits of that will probably start being visible in the next 2-3 quarters, let's say. So I won't be too surprised if you start seeing in the market getting further related, even though if you look at the valuations currently, they look at on the higher side, especially if you look at the the historical trading band for the BSE 30, 12-month forward basis, somewhere about 13 to 17 times. And as of now, we are pretty much at the high end of the historical trading band. But you can always see re-rating if you start seeing a lot of positive news flow in the economy, which can translate into a higher earnings growth in the medium term through higher GDP growth. and B, lower cost of capital through improvement on the fiscal side. And at some point in time, the RBI will hopefully act, if it starts getting more comfortable with the inflation scenario, with fiscal improvement, etc. So if these factors play out in the next 2-3 quarters, don't be too surprised if the market moves up further. But it is imperative now that reforms come through, because expectations are very high, valuations are on the higher side, and people are assuming that reforms will come through. So let's see. I mean, we remain in the positive camp, and hopefully the government will deliver.
All right, Sanjeev, but just one final question, if you can answer it, in a very crisp fashion. For the rest of the year, do you think there's more money to be made in the defensives like technology and pharma, or do you think cyclicals will still rule the roost?
Well, difficult one, but if let's say once elections are done with in December, January, and you see more reforms getting announced, and I won't be too surprised to see the cyclicals continuing to perform reasonably well. And when I say cyclicals, I would look at more the auto, banking, and to some extent the consumer discretionary space, which is where we have the bulk of the money in our model portfolio. See, as far as the overseas names are concerned, what I worry about a little bit over here is that valuations are quite high now for pharma companies. I mean, they have been fantastic performers in the last 2-3 months, and IT companies are a little bit struggling with top line growth. We are looking at about 9 to 16% top line growth for the tier 1 companies, including Cognizant. With that kind of top line growth, assuming there is no impact to the rupee, bottom line growth is not going to be very high. It's going to be in the low teens, mid-teens kind of a number, which means you can't theoretically argue for anything beyond 15, 16 kind of multiple. And most of the stocks are already trading at about 14 to 16 times on March 16 basis. Of course, TCS is almost at 20 times March 16. So I am not very sure you can see a re-rating from where we are unless until the rupee starts depreciating, which I see no reason. Looking at India's current account and BOP situation, very unlikely the rupee should depreciate meaningfully from where we are. So in that case, I don't think the rating is further possible for the IT as also the pharma companies, more in terms of where they are trading, not for any other reason. I mean, they are fantastic companies, but how much do you want to value them for a certain amount of earnings growth? It's become difficult beyond a certain level.
All right, Sanjeev, thanks a lot for your time today. Really appreciate your views and your time. That's Kotak Institutional Equities with their call on the market.